Palantir guided for revenue of 528 to 532 million, adjusted income of operations 118 to 122, and to be GAAP profitable. Full year guidance consistent of revenue between 2.2 billion, adjusted income of 506. For Palantir to continue the trajectory and get back into the 20s, I feel we need to see growth across every aspect of the business that Palantir is capable of delivering. First is customer count. Any words on that?
Yeah, I mean, look, I want to see, and it is almost midnight and I'm freaking half asleep. So you would have to go by the numbers I put because I don't have it freaking memorized right now. But I want to see the trajectory stay the same. Just bring up the chart. You don't have to go through the numbers. I mean, the biggest thing with Palantir was this is a company that was always known as a black box. And the big question was always commercial. It wasn't government contracts because they were embedded in the military industrial complex. It was, does it translate over to the commercial side? We've seen exponential growth on the commercial side, and we need that to continue going up. And I'm hoping with all these conferences that continues to occur. And I want to see revenue get past 600 million in a quarter this year.
So you want that to happen next quarter or Q3?
No, I mean, I don't think it's going to happen next quarter, but I think revenue's got to be over 550 million next quarter.
So that's 20 million more than they guided for.
And I think they're sandbagging because to get to their high-end expectations, they would need revenue to come in at like 550, 575, and 601 million just to hit the high end that they got it for. So if you go back to 2020 or Q1 of 2021, I don't remember which presentation it was in, they said they were going to be 4 billion plus in 2025 revenue. They're not on track for that right now. So I want to see them hit the high end and get past 600 million in a quarter, because then that paves the way to get to a billion quarterly revenue. And I think we got to get there. And the biggest thing to me is obviously profitability. Their free cash flow margin is amazing. It's 35%, well, 34.77%.
Why is that amazing for a SaaS company?
We're not talking about gross profits. We're talking about the free cash flow margin. Every dollar that's generated, you're getting over 30%, more than a third of the dollars free cash flow. That is huge, absolutely huge. So if they continue to go on that and go down to Salesforce, the Salesforce graphs.
And that graphic about free cash, that's why I've been so bullish about the company for such a long time. It's because everyone was talking about they're not profitable. It's like, well, they're not profitable due to the share-based compensation and how that hits the net income on a GAAP basis. But if you look at that,
net income is easier to distort because of the way GAAP accounting principles are. Free cash flow has always been my favorite metric because it's cash in versus cash out.
Yeah.
So,
but the valuations for high tech growth should always be done in price to free cash flow. That's the key.
And I get there in this article. Yeah. So go down to the Salesforce stuff. So I want to see them do a Salesforce arc. And if they continue on this trajectory, I think they can. Look, Salesforce is a $240, $250 billion market cap company. I mean, take the TTM out of it because we only have one new quarter in numbers. But you look at that arc of revenue growth, it's absolutely immense. Salesforce's free cash flow, the next slide down, I mean, they're generating around 6.5, 7 billion free cash flow a year.
What is their margin?
24%, I think.
Oh, so we have a better free cash flow margin.
It was like 23, 24.
Yeah, it's in the low 20s.
So the only way you can get a like above 30% free cash flow margin is if you typically have 80% or whatever adjusted gross margins, right? That's the key to getting there. That's why like Coca-Cola can't do that.
The key is low capex, and I mean that's really the key. Spending less cash. Go to the chart under the table underneath. So people love to say, this is where I get into a lot of arguments with people, that 30x free cash flow is not realistic to value companies at. Well, can I curse on this?
Of course, Steven. I've been waiting for this to come from you.
Fuck it isn't. Pepsi Cola is not a fucking tech company. Trades at 45 times free cash flow.
What?
Not a tech company. Trades at 29 times free cash flow. Like,
wow.
Not tech companies are not the only companies that trade at 30x or over free cash flow. Take Tesla and Nvidia and them out of it, okay? Oracle trades at 43 times. Costco trades at 42 times free cash flow.
That's because their Cheerios are phenomenal.
So to say that these multiples are ridiculous and tech companies are overvalued, okay, well, then you got to say that almost everything is overvalued because Pepsi is a defensive stock and that's trading at 45 times.
Yo, if a defense contractor like in a mission is drinking Pepsi, could Pepsi be considered a defense contracting company?
Very funny.
Okay,
Can you
Chris.
can you share my screen real quick? So this was provided by Brad Gertzner with Altimeter Capital. It's a really great breakdown of software margins. We can see where everyone is. Adobe, baby, Adobe's at the top. Look at that free cash flow. Adobe's just a
Wow.
money generator. You know, it's like literally an ATM.
Adobe's
Now-
free cash flow is Premiere.
Yeah. Now look at our
Everybody
friend
uses
C3.
it.
Did you get
Let's
the joke?
look at
It's like Premiere. It's like, all right.
Let's look at our friend C3 AI. They're not very well. They're
What's
at
theirs?
the bottom end.
Oh wow.
And
Oh,
let's
God.
look at Palantir. Where's Palantir? Palantir, right here. You see right here? They're above the median. Boom. Right above the median, I think. Yeah. In terms of 12%. So you can see here, these are probably like the less investable stuff. This is literally on the cusp of really good investing. And I suspect over time, Palantir's goal is to go from here to here to here to probably somewhere around here.
Chris, what time frame is he using? Is he using TTM?
I think he's NTM, which is I think it's
Next.
TTM. Yeah,
What is that?
Yeah.
Next 12 months?
I feel like it's next 12 months.
yeah, it's next 12 months.
So I was doing the free cash flow on a quarterly basis, and their margin was 34.77% in Q1. Q4 was 14.53. I mean, and my big thing is they got to stay above 30% margins. They can't revert. They just can't do it. Like, they got to beat estimates on all fronts. They got to gain new customers. They got to gain more contracts. And they can't go below a 30% free cash flow margin. And look, if they are not GAAP profitable this quarter, this thing's going to implode, in my opinion. Like, they got to be GAAP profitable. They can't set it.
Yeah, the
And if they
valuation
don't-
is extended.
and if they
Valuation
don't
is
do
extended.
and if they miss again next quarter, it is completely going to screw up their possibility of being in the S&P 500 in Q4. I mean, they could possibly be at it in Q4 because you have to have the sum of the trailing 12 months, so the sum of the past 4 quarters, be GAAP profitable, be considered for eligibility, 12 billion market cap, and some other metrics. So,
Yeah, but that's easy. But that's easily done, dude. As an executive,
Hopefully.
you just cut the fat. That's all you do. You figure out where your operational expenses are that are literally draining cash, that are not providing value. You do operational, late cutoffs where you have to, and there you go. You can maintain your free cash flow. I mean, most of the time, especially with Palantir being a data centric company, they can see where their waste is and reduce down their waste and make sure that they keep their GAAP profitability up. Whether that means laying off non-performing staff, ending contracts that they have with
Vendors.
catering services, catering to the office, closing some leases that are existing right now that they're not utilizing. So those kinds of things are what management can actually take action on. So I do not think that they're going to go the other way in terms of GAAP profitability
I
and
hope
free cash flow.
not. To me, the big thing is, can they sustain? Because revenue growth has been declining quarter over quarter. I think it's just under 20% now. I mean, I'm sorry, year over year. If they can sustain 18%, which I don't know if that's likely or not. We saw previous estimates that were really high in 2 years ago. But if they can maintain 18% over the next decade and maintain a 33% free cash flow margin, they'll be generating $11.78 billion in revenue and $3.89 billion in free cash flow. At a 32x multiple, that values the company at $124 billion.